All right. What's up, everybody? Welcome to another episode of What the FICC. I'm Spencer Isbell here with Ian Cully, head of fixed income, currencies, and commodities at All Star Charts. Mr. Cully, how goes it?
Excellent. Friday.
It's Friday. That
Friday.
means
Happy
we're
Friday.
automatic. It's a summer Friday. There's not many of them left. It means we're automatically in a good mood. All right, Ian. On Wednesday's show, we talked about some emerging market currencies. We're going to pivot away from that world for a second. We're going to go to the commodity space today. Is that right?
That's right.
Yeah. So we're talking about energy and commodities more broadly. And what's the idea here? What's the idea we have through the end of the year?
Well, I mean, we've been talking a lot about energy lately.
Yep.
I mean, highlighting a lot of individual equity plays. And this past week, we've seen a lot of strength from the individual commodity contracts. Crude oil is breaking out, rebar's breaking out, heating oil's ripping higher. So, the big question on my mind is, will the rest of the commodity space follow, specifically base and industrial metals? And we'll see if the other major pro-cyclical commodity group is going to start catching higher. And with copper below $4 and still churning sideways, I mean, it's really up in the air.
All right. To help us break it down, we have a special guest. Will Rind is the founder and CEO of Granite Shares. If you trade commodities, you've most certainly seen their ETFs. Will, thanks for coming on, man. How's it going?
Doing well. Thank you so much for having me. Good to see you.
Likewise. So why don't you just sort of, from your point of view, just set the stage for us, and then I'll see myself out and eventually let you guys, geek out a little bit more, but just set the stage for us if you can, just about what you're seeing in commodity land.
Yeah, no, I'm happy to give you my thoughts. So kind of as Ian was saying, we've seen really some decent strength, in the energy market. And, maybe to kind of set the scene, at the start of the year, obviously the narrative around commodities was very much the same as the narrative around the market more broadly, which was we were heading into some kind of imminent recession and everything was going to fall off a cliff. And, to a certain degree, commodity prices reacted to that and have come down certainly for, the last sort of few months. And really that was one of the things that was driving inflation down. And we keep these, positive inflation readings driven largely by falling commodity prices. But kind of against the backdrop of rising stock prices, something interesting has been happening, and that is that commodity prices now, particularly driven by energy, have been rising over the last couple of months. If you look at June, those figures came in for June. We actually saw global oil demand reach an all-time high, 103 million barrels per day consumed. So against this backdrop of, hey, we're in a recession, everything's slowing down, etc., suddenly the figures come out and hang on a minute, we're at an all-time high in terms of oil consumption. And by the way, August, obviously, which we're still in now, but certainly July and August expected to be even higher than that in terms of oil demand. So what's going on? Well, I think that, what is happening here is that commodities oversold in the first few months of the year. And, we're seeing significant demand coming out of the oil market. But I think that will start to be reflected in some of the commodities. If you do look at market like copper, then yeah, you can't say that we're in a sort of an upwardly bullish trend. It's too early to say that. But prices have been creeping up again over the last couple of months, setting the stage, I think, for a backdrop of higher prices towards the end of the year. Now, the only X factor really when it comes to base metals, but particularly markets like copper, markets like iron ore, is going to be what happens with China. And as we all know, that the Chinese economy is sort of stuttering at the moment. And really the big question is, to what extent is the government going to step in and stimulate that market and provide support? If they provide support, I think that's positive for the commodity market. And that's really the key piece, I think, in my mind, between now and the end of the year.
And we've seen a lot of Chinese equities start to react higher in the near term or over the past month or so. Do you tie that to some of the news coming out of the potential stimulus from the Chinese government?
Yeah, I think it depends. I mean, certainly a lot of the tech names
Mm-hmm.
have benefited clearly largely from the sort of the settlements, if you will, that the government has agreed with the companies like Alibaba, et cetera. So their future is now seemingly a lot more secure than it was a few months ago. But I think in terms of the underlying commodity space, we're starting to see that pick up. I mean, certainly, Chinese demand for coal as one metric was higher this year than it was last year. And so demand has been a bit weaker for copper and some of the other core metals, but still in places like, for example, coal, that demand is higher. So copper is so intrinsically linked to the construction industry, along with steel, of course, and that really is the main area of the Chinese economy that's at risk at the moment. And so I think if the government can stabilize that, if it can provide some support, then there's reason to believe, in my mind at least, that we could see a recovery in some of these key metals, between now and the end of the year.
Got it. I think it's really interesting. You mentioned coal. I mean, coal stocks have been ripping over the past few days. Definitely ripping this week. And I believe I read a month or so ago that Glencore was looking to acquire the coal section of Tech Resources. So I think it's interesting to see, major commodity houses, start to really, play the coal.
Yeah, I mean, it's sort of come back from the dead, hasn't it? Over the last sort of couple of years, where people really wrote it off as being, a kind of dead commodity that really had no place, in a world that was decarbonizing. But clearly, all of that has changed, and there's been a huge demand for coal. And again, largely that's a lot of that has to do with price, of course, price relative to other forms of energy. And when we had oil prices soaring to over $100 a barrel, it made for a lot of countries and for a lot of operations that have the choice, consuming coal is a lot more attractive from a price perspective.
Yeah, absolutely.
Will, what do you think is, if you could put your fundamental hat on for a second, what do you think is driving all this demand in oil, for example, or anything?
I think it's kind of this similar phenomenon to what we've seen, in other parts of the economy, which is that this, let's call it pent-up demand, that happened post-COVID or coming out of COVID, has continued. And again, despite all of the negative narratives, when you look at what's happening to the U.S. economy, you still have strength that I think has caught a lot of people by surprise. Both economic strength, clearly in terms of the actual numbers, low unemployment. And so from that perspective, you look around and things aren't actually that bad. And so, that to me is an indication that things are actually, better than thought, but it's still largely, I think, about this sort of pent up demand that is still continuing from what we saw in COVID.
So is that a demand you see waning over, say the coming few years?
I think, like everything, Spencer, be very much dependent on economic growth, clearly.
Right.
So growth has been good. It's been better than expected. And I think that's why if you look at the oil market right now and look at gas prices on the rise again, it would caught people by surprise. I think a few months ago that oil prices were definitely on their way down, gas prices on the way down. So, it's very much linked to economic growth, and that is fine at the moment. Now, clearly, the big question is, from anybody, are we going to see a slowdown? When are we going to see a slowdown? Or, is it going to be an outright recession? And then clearly you're going to get demand destruction in that kind of environment. I still think that things look, at least from my vantage point, things look pretty strong still for this year. So I don't think that I don't think we're going to looking at recession, or that's not a scenario I'm looking at for this year. But certainly the impact of higher rates, we all know that there's a big lagging effect to that. And I think is a possibility that we could see something next year.
What's interesting is, everyone seems, we get this big tech rally in the first half of the year. I believe the NASDAQ had its best first half in history, NASDAQ 100. And now it seems, maybe it's just my Twitter feed, but there's a lot of chatter out there, calling for lower rates. But I look at the charts, I look at the 10-year, I look at the 30-year, and they're clear structural uptrends. I see absolutely no signs of rates rolling over. And I think that's really interesting. And, we were going back and forth before you came on the show today. You made a comment that no one's really prepared. That most investors just simply aren't prepared for a commodity rally going into the back half. And I think that fits with this, coming off of this rally in tech and this idea that, bonds are going to start catching higher and rates are going to roll over. What are the best plays? What are the best plays in the commodities space, in your opinion, heading into year end?
Yeah, I mean, I think maybe just to kind of riff off of what you were saying just for a second, the risk to me is that, it's the one sort of, you look at the contrarian, what's the contrarian thing to think about at the moment? It's that inflation actually goes higher. I think that a large amount of, what's been built into the market narrative, the narrative around the Fed, specifically, is that inflation is gone. And inflation is going to keep falling, and it's going to keep falling. Maybe not exactly back to the 2% level, but it's going to keep falling from here. And I think the one thing that no one's really thinking about is, well, what happens if inflation actually starts to go back up again? And clearly that would derail a lot of the narrative, particularly around the stock market, between now and the end of the year. And I think clearly a key part of that has to be performance of commodities, and commodity prices, continue to rise across the board between now and the end of the year. That could very well reverse the narrative that we've been seeing certainly the first six months of the year. Oil, I think, has gone up a decent amount. I'm not saying that there's not more room for oil to climb between here and year end. We've certainly seen that the last couple of years. But I think, again, going back to what we were saying about the base metals, I'd look to areas of the market like that haven't done well year to date, largely on the back of this recessionary narrative. But I think that if we can start to see some signs of China rekindling that demand, that the stimulus being put in by the government, trying to help the property market, trying to stabilize things, but drive some demand there. I think that copper, some of these key metals would obviously be the major beneficiaries in my mind between now and the year end.
Ian, show us some of those charts, those base metal charts.
Yeah, so this is an overlay chart of our equal weight energy index, ex ethanol. So crude oil, heating oil, gasoline, and natural gas. And it's overlaid with our equal weight base metal and industrial metal index, copper, aluminum, steel, nickel, tin, zinc, lead, iron ore. And you see that the base metals are continuing to base, no pun intended, continuing to construct a I believe is a constructive basing formation as energy is starting to catch higher back towards those pivot highs from late 2021. I think there's plenty of upside room for crude oil as long as it's above 83.25. I think the path of least resistance is higher as long as it's above this, that level, above the shelf of former highs here. And it's really constructive to see its distillates start, to pick up, to see the demand in the distillates and gasoline. There's a chart of the September gasoline contract ripping higher, trend reversal in heating oil as it prints an overbought, very bullish momentum reading, breaking out of a bearish momentum regime. These are the kind of things I look for from a technical perspective. See, the market is starting to turn. You know, again, like steel doesn't look great. Steel futures back below that cycle peak from 2018. Gasoline, or excuse me, rebar, looks like it's forming a potential top. But tin looks good. From what I understand, tin's in everything. So tin back above, the shelf of former highs and the 2018 high, I think is constructive. But again, copper below $4. I think that's a big level for copper. I think copper gets back above $4, and it's off to the races potentially. A very different story heading into 2024.
I want to ask Will about flows, or unless you have anything to say to that. I don't know.
Well, no, just if you look at the chart again, it's interesting. We look at the prices for copper, going back to prior to COVID, I guess. So if you look at that period, seems like on the chart, up until well, I guess quite there on the left, but higher levels of economic activity, a lot higher prices, and clearly we just haven't got back there yet.
Well, I want to ask you about flows. A lot's been written and said this year about the outflows, broadly speaking, in specifically the energy sector, as far as ETF fund flows are concerned. As an ETF issuer yourself, how do you consider fund flows as an indicator of bullishness or bearishness, or do you not?
Well, I mean, we absolutely do, because clearly it's an indication. The best indication ever is what people are actually doing with their money. Putting the money where their mouth is, versus just talking about it. And I think again, the outflows that we've seen, certainly on the broad commodity side, have been indicative of the fact that people have missed out for large part, I think, on the rally in stocks. And you've had that kind of alligator jaws, if you will, of divergence in performance since the beginning of the year, where commodity prices have come down over the last 6 months, and the stock market has gone to 20% or whatever plus on the S&P, 30% on the Nasdaq. So a lot of people have missed that and trying to chase that performance, and therefore a lot of that money, if it's not already in the market, it's being reallocated from somewhere like commodities, or it's coming off the sidelines from cash and into the market, but not being allocated to commodities. So I think that's been the story of the first half of the year. First half of the year has been weak, but price action has been weak. It's really just a question of now, the second half of the year, heading now into year end, will we start to see people come back into the market? The view that maybe prices have been sold off too much here against that backdrop that we've seen in stocks.
Yeah, I really like the weekly note from Granite Shares and that snapshot of the fund flows, and the only positive flows are in Energy X crude oil. I mean, there's net outflows for the entire commodity space.
Yeah.
So I think investors, after a decade of abysmal performance from the energy sector, investors have been apprehensive about getting back into that space, even over the past couple of years. And we saw that massive dispersion between the performance of XLE and Tech XLK heading into the top. Do you think investors are going to be ready to get back into energy after watching tech underperform energy for a year and a half? Or is the recency bias gonna tied to the past 6 months or to the first half of 2023?
It's interesting, man. I'd almost say it's really now, how many people will stick with the energy market. And specifically, if you look at, how overbought energy was. And like you said, there was, 10 years in the wilderness where, energy major oil stocks did nothing for 10 years. And then, since the bottom of COVID, up until really the peak, we had this just unbelievable move in companies like Exxon, et cetera, which, hadn't really moved anywhere for the prior decade. And so people, doubled, tripled their money in some of these large companies over the last 2 years. Clearly that was by far and away, the trade of last year, to be long these value stocks, but particularly in the commodity space, energy stocks, and be short tech. Now, all of that reversed this year. And I think a lot of people, sold out in the rally that we saw in tech for the last 6 months. The question is, now how many people will stick with the oil stocks, going forward versus, rotate out of those into something else.
I want to switch the conversation to gold. I gotta ask you about gold. What are your thoughts on just gold and precious metals in general?
It's a bit of a tough spot. I mean, again, lackluster probably is the word I'd use to describe it at the moment. I think it's largely, the first half of the year I think was pretty good, and started to get derailed a little bit about after the debt ceiling announcement. I think there was some expectation that could turn into a tail event, but obviously didn't. And then really gold has suffered in the last couple of months or so from the idea that well, not the idea, but the resurgence in rates moving a little bit higher, the dollar moving a bit higher. So it's really kind of capped the upside of the last couple of months, and so we stuck in around that sort of 1900 level. And so I think to break out from there, clearly we need yields to move down from where they are. We need the currency to move down, the dollar to move down from where it is. And so I think it's going to be a little bit challenging in the next sort of couple of months or so.
So those the lower yields and a weaker dollar are a need, not a want for a breakout in gold.
Well, they're both, but I think if you're in the market, then you absolutely need that to happen. I mean, absent of some kind of dislocation, but it doesn't look like, again, that unless you're talking about some kind of shock that's completely unpredictable, that it's not going to come from the recessionary forces that, again, people were predicting coming into this year, at least I think for the remainder of this year.
Yeah, it's kind of where my head's at. I've just, I'm still bullish. I'm still bullish gold as long as it holds above, the prior commodity super cycle peak from 2011. As long as it's above the 19 and a quarter. I still like it. It's just tough. It's tough finding a good risk reward trade right now, though.
Exactly. Yeah, and I think gold's definitely a longer term payoff, at the moment. And I think that, again, part of the reason why we're talking about the rest of what's been happening in the markets is that the impact of rising interest rates is really a lot more lagging than people expect. But we think about, one aspect of gold, which is, really since the financial crisis, we've had, absent of those few months clearly within COVID, but we've just, bankruptcies or credit events have just been unheard of in that particular time. And clearly now we're coming into a situation where, the impact of high rates is, 100% real and is going to be felt, throughout the economy, starting with commercial real estate, but will filter through to residential real estate and any other aspects of the economy, be it auto loans and, anything that involves interest rates. And from that perspective, I think, gold sitting very nicely, as an asset of the highest quality that doesn't have any credit or counterparty risk. And if things start to break down, I think there's 100% going to be demand for gold like we haven't seen for some time, in that kind of environment.
Okay, so really the question of the day, the question we started off with, or the idea that we started off with, Will, was, we're seeing a rise in prices in energy, and does that translate to the broader commodity complex? Aside from the obvious of just, you'll know it when you know it, is there one market or one indicator that will tell you, yes, this is happening? Or is it just wait and see for any or all of them?
I think you've got to be, you've always got to nuance that slightly in terms of, there are obviously specifics to each market. But again, I think, to me, I always look at the price of copper as being really a good indicator, broad brush indicator of that sort of fundamental demand, and particularly from China. That's the big one, really, that we need to see, I think, before we can start to really seriously talk about, a broader rally in some of the other metals or other parts of the commodity complex.
So the back half of the year is already starting to look very different than the first half, and heading into the end of the year, into the holidays. For now, the focus should be on energy, in terms of buying opportunities, and wait and see how copper does. Wait and see if copper can reclaim that $4 level, and other strength from the base metals to expand into other areas of the market, metals and mining. And gold probably not going to be a play. Does that sound right?
I think so. I think for now, at least. That to me, the big one, like I said, is the energy markets, all-time high in terms of global oil demand. I think that will continue. We know this is a problem. We know that the Biden administration looking to put more barrels onto the market. Looking to even countries like Iran to put more barrels onto the market. So clearly, everybody knows that the market, from a price perspective, needs more supply, and so trying to search for those barrels to put more supply onto the market. It's really just, I think, for me, China holds all the cards, broadly speaking, when it comes to stimulating demand for the next into the back half of the year.
That's a great spot for the world to be in.
Or are we going to get a rip-roaring rally in natty gas? What do you think?
Difficult to say right now. Obviously, we have to, I think, get closer to the winter time and see some very. But I mean, again, when you look at the performance of some of these commodities, a lot of these commodities sold off a lot this year, so have room to rebound regardless of the weather situation or the weather fundamentals.
Yep. All right. Do you have anything else, Ian? Because I think we're about out of time.
No, that was great. Thank you for coming on, Will. This was amazing.
Yeah, great. Thanks for having me. Pleasure, as always.
Will Rind, founder and CEO of Granite Shares. Check out their ETFs. We do gold, comb. It's on the site. Will,
platinum, everything.
Yeah.
Always a pleasure, man. Thanks a lot.
Thank you. Appreciate it.
All right, that'll be a wrap for us here on What the FICC today. We'll be back on Wednesday, because we air every Wednesday, every Friday, 11:30 a.m. Eastern time. If you like the show, drop us a like. If you're watching on Twitter, maybe hop on over to YouTube, hit the like there. If you're watching us after the fact, that's okay. You can still like the stream. We'd appreciate that. Subscribe to our channel. Check out Ian's blog, obviously, on All Star Charts. And I think that's pretty good, right?
Yeah, we covered it.
All right. Have a good weekend, everyone.
Thanks for watching, everybody.
Cheers.
Bounce it up. que bounce it, papa.